Copper hit $14,000 a ton this week, a record, while oil simultaneously pushed past $126 a barrel, and Canadian markets moved in opposite directions on the same day. That split is the signal worth examining, because it points to a transmission problem the headline numbers obscure. The Strait of Hormuz carries roughly 1/5 of the world's oil and LNG. Before this war, energy experts twice rejected modeling a full closure, in 2007 and again in 2022, because the consequences were considered too extreme to plan around. Those same experts are now watching prices the 2007 scenario took a full year to reach appear in 2 months. When the unthinkable becomes operational reality, existing hedging frameworks misfire, and capital repositions not toward the most accurate forecast, but toward the widest safety margin. That repositioning is visible in how the TSX has traded. The index rose Monday, even as global risk appetite fell, because Canada's energy sector is a direct beneficiary of sustained high crude prices. Keyera just closed a $5.3 billion Plains acquisition, and Peyto reported a record quarter with a 9% dividend increase. But that same oil price that lifts the TSX's energy component is now grounding Air Canada flights. The airline confirmed it is halting 4 seasonal U.S. routes ahead of schedule due to jet fuel costs, a line item consequence that compresses airline margins and passes through to consumer travel budgets. Higher crude prices are simultaneously expanding one part of Canada's economy and contracting another, which means the TSX headline number is hiding a sector-level divergence that carries different forward implications depending on where capital is positioned. What the energy sector's outperformance doesn't resolve is why copper, which has nothing to do with Hormuz directly, is also at a record. That question forces the analysis into a different causal lane.
Copper's move above $14,000 is being attributed to Chinese demand recovery and supply fears, but the Hormuz closure introduced a third variable that the standard copper thesis doesn't price in: refining disruption. Copper refining is energy-intensive, and with LNG flows through the strait constrained, smelting costs across Asia are rising at the same time that China is re-entering the demand side. A commodity hitting a record because both its demand and its production cost are rising simultaneously is a fundamentally different signal than a demand-only rally. The margin structure for producers improves, but the input cost pressure on downstream manufacturers widens. For Canadian miners, that distinction matters. Solaris Resources received EIA technical approval for its Warintza copper project this week. Defense Metals launched a pilot flotation program for its rare earth project in British Columbia. Inomin and Sumitomo commenced a $2.3 million exploration program. These are early-stage catalysts, but they're moving precisely because the capital flow logic has shifted. When copper trades at record prices and supply chains face structural disruption, exploration-stage assets price in a longer duration of elevated commodity prices rather than a mean reversion assumption. The countersignal, as an exception to that bullish read, is that the Iran war's impact on global growth is itself a ceiling on industrial demand. If the conflict persists long enough to slow global manufacturing, which the closed strait is already beginning to do, copper's demand pull weakens even as its supply push pricing holds. The commodity would then trade on geopolitical premium rather than fundamental demand, a condition that reverses sharply when a ceasefire framework closes. Rubio and Witkoff met Qatar's prime minister in Miami on Saturday. The U.S. and Iran are negotiating a one-page memo. If that memo signs, the geopolitical premium in copper unwinds faster than the underlying demand thesis can support it. That same ceasefire probability hanging over copper is the condition reshaping how Canadian gold is being priced, but in the opposite direction.
Gold has pulled back from its highs as U.S. inflation data clouded the Fed easing outlook, and silver jumped to a 2-week high on the Iran deadlock, a spread that reveals the market's bifurcated read on duration. Silver's move prices a prolonged conflict. Gold's dip prices the possibility that a deal closes before the Fed is forced to pivot. India's attempt to suppress gold buying as forex reserves drain under oil costs adds a third pressure point. The world's largest physical gold buyer is being administratively restrained at the same moment geopolitical demand should be peaking. Barrick Mining's $3 billion buyback, announced this week alongside a North American spin-off plan, is positioned against that ambiguity. The buyback signals that management sees current gold prices as durable enough to return capital rather than deploy it into production growth, a judgment that implicitly bets on the Iran conflict remaining unresolved long enough for gold to hold its premium. The 4-mile discovery in Nevada, which Barrick calls one of the century's greatest, could be vended into the Nevada Gold Mines joint venture with Newmont ahead of schedule. That early inclusion would accelerate the North American spinoff's valuation case, but only if the gold price environment supports the re-rating that the spinoff is designed to unlock. The verification benchmark is the one-page Iran MOU. Trump set an informal deadline tied to his China trip next Friday. If no deal materializes by then, the war premium in gold should hold and potentially extend, and Barrick's buyback logic is validated. If the memo signs before that date, the pressure shifts. Gold gives back its war premium, copper's geopolitical floor drops, and Canada's energy sector faces a crude price correction that reverses the Keyera and Peyto tailwinds in the same week they appeared most durable. Canada's 18,000 April job losses, the third monthly decline of the year, were absorbed partly because the energy sector was hiring against high prices. A ceasefire that deflates crude changes that arithmetic before the next employment print arrives. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.